Bob, great to have you back on A View from the Street, especially on such an eventful day, both from a Fed and markets perspective. It feels like we haven't chatted in over 6 months or so. It's been a while since we connected, and of course, nothing's really happened since then, right?
It feels like a lifetime ago, the last time we got on the podcast and chatted. But that's what makes life interesting, right? It'd be too easy
Abs
if everything was stable.
Yeah, I'm with you on that. And just as a brief introduction, again, for the folks that are tuning in, we appreciate it. Joining us today is Bob Elliott, CIO and CEO of Unlimited, a firm using machine learning to replicate the index returns of alternative investments. Unlimited is bringing the index revolution to the 2 and 20 world by creating low-cost ETFs through replication hedge fund strategies. So let's go ahead and dive right in. We finally got the much anticipated Fed rate cut today, right? Something Powell hinted at during his Jackson Hole meeting. And alongside that, we've received some updated summaries of economic projections, right? Looks like the Fed on average is targeting a Fed funds rate of 3.6% by year end 2025 and 3.4% by the year end 2026. Inflation looks like they're targeting about 3% by the end of this year and 2.6% by the end of 2026. So looks like we're, based on their projections, right? We're looking at a scenario of potentially stronger growth, lower inflation, and fiscal stimulus, thanks in part to the One Big Beautiful Bill. What could possibly go wrong here?
Well, I think what we're seeing with this set of projections is that the Fed, continues to prioritize the labor market mandate ahead of the inflation mandate. I mean, just based on their projections, uh, you know, they're likely to miss their 2% inflation target now for 81 months,
Right.
which, at some point, when you miss your inflation target for that long, it becomes a whole heck of a lot less credible. And instead, they're really focused on the labor market, delivering cuts at a time when we've seen a slowing, a weakening of the labor market, but certainly not the sort of weakening that would typically align with a relatively aggressive cutting cycle that is being painted in the dots, at least at this point. And so I think what we're seeing is, basically all assets have benefited from the increasing expectations of the Fed relatively aggressively easing. And that's been a big driver of the market action in the last couple of months.
Yeah, and I mean, if you just think about what has transpired, especially post the Liberation Day announcement, and we'll call it, the tariff tantrum, if you will. Equity markets have really done the full round trip, right? And we know financial conditions have eased in the process. But all things are pointing to just a slower and weakening labor market, something that you touched on, and in almost an uneven way, right? If we look at the cohorts that are potentially the most impacted, we look at the demographic of recent college grads, right? Is this something that we should have more concern about from the perspective of AI displacing this cohort of workers? We know that so much of artificial intelligence, of course, is positive for corporate bottom lines and profitability. Is it possible that we still see equity markets at an all-time high and corporate profits rising as a result of this new dynamic through productivity and not hiring this cohort of workers?
Yeah, I think when you look at the labor market shifts, as you note, the primary deterioration has been, I'd sort of describe as at the edges, meaning
Sure.
particularly that like the 16 to 24 cohort, that is, either high school jobs or, high school graduates or recent college graduates are facing the most difficult challenge. I think it is still a little too early to tell whether that's AI driven or is it just the sort of typical cyclical downturn, leading cyclical edge that we see in weaker economic environments. Because if you look back through time, what you see basically cycle after cycle is the first folks to stop getting hired are the people at those edges, particularly the younger cohort, and then eventually that bleeds into the rest of hiring across the economy. So we might be seeing some cyclical effects. We might be seeing some secular effects. I think when it comes to the AI story, so far we haven't really seen a huge boost in productivity from AI. Recent measures in terms of productivity continue to be relatively benign, 1.5%. And so, which is not that much different than we've seen the last, 10 or 15 years in the post GFC period. So I think there's, folks are adopting AI, but there's a real question of how does that translate to top line, right? Because that's
Sure.
what you need for productivity. You have to generate more income rather than essentially just absorbing it in consumer surplus. And so far, it has mostly been absorbed in consumer surplus without much impact on actual economic activity.
Agreed. And I would also add to that, if you look at just where most of the CapEx spending is coming through it from a corporate perspective, it's definitely investment in AI-like technologies and data centers and what have you. And it's, when you look at just the productive capacity of the economy, rather than reinvesting back into labor and employment, who knows what these long-term impacts are from a profitability perspective. It would seem like it would be positive, although again, it's tough to quantify at this current juncture, as you pointed out, right?
Yeah, I think the real challenge with let's say significant labor saving technology like AI is at first blush it seems like it should be beneficial to corporate profits, right?
Sure.
You could basically use AI in replace of labor. The challenge with that story is that to the extent that there are job losses associated with it, it means someone's income is lost, and that income is important for maintaining top line spending. And so if you look back through time, what you have to see is you have to see either someone disave, meaning households would have to disave, the government would have to borrow even more than the current deficits, or you're going to see a hit to growth as associated with the reducing labor. And so I think it's much more likely that what we see is a gradual improvement in productivity, akin to what we saw with the personal computer.
Sure.
And we don't see a lot of immediate help in terms of the bottom line for a lot of companies, and that most of the benefits will accrue when you see labor getting more productive, which means the existing labor can then produce more income, which means that it supports top line. So margins may not actually improve much, but growth would improve over time. And that's in general how these technology adoption cycles work, is it's much more important, much bigger driver on the top line than it is on the bottom line.
Interesting. So any additional thoughts, post the FOMC meeting, shifting gears here slightly, any additional thoughts from that perspective?
Well, I think the main thing with the FOMC to take away is that the vast majority of the committee is somewhat slow moving in terms of their desired ease. The idea, at least that just because they cut 25 basis points today means that they're going to blow out the easing over the course of the next 6 or 9 months. It doesn't necessarily line up. Like, even if you look at the dots, some folks said no more cuts this year. Some folks, added to them the folks that think that there's going to be one more cut this year. You get a majority, and then there's sort of a right tail of folks who think that there's going to be a lot more cuts this year. And so, I wouldn't necessarily. There's a lot of uncertainty. That's the main thing I would say, is that there's a lot of uncertainty in the outlook, both in terms of the growth and inflation and policy. And so I wouldn't necessarily just extrapolate, we're in a huge easing cycle here, which is a little different than what the markets are pricing in, which is relative confidence that we're in a pretty aggressive easing cycle in the near term.
Yes, so in essence, what you're saying is, it'd be wise not to extrapolate additional rate cuts due to the fact that number one, there's so much uncertainty around the around tariffs being injected into potential price increases, which looks like that we're seeing now with inflation starting to modestly reaccelerate again. So it's a little bit of a wait and see from the FOMC perspective. Um, even though, the labor market is weakening, it's, if we're reading the tea leaves in terms of what Fed Chair Powell communicated, and of course, everyone will be going through this over the next few days to really get uh, a further clear picture of how they should proceed. It's it's more data dependent. So that's essentially what we're getting, right? They had enough room to ease at this point, at this juncture, just given the softness in the labor numbers, and it's more of a wait and see, and we shouldn't extrapolate a rate cutting cycle.
Yeah, I think that's right. And for financial assets, that's an important that sort of you know, a conservative outlook is important because essentially all financial assets the last few months have really had a big benefit from a fall in, discount rates.
Right.
Reflective of the fact that the Fed is shifting towards an easier policy. What I'd say is that largely is priced in. A relatively aggressive easing cycle is already priced in, and so getting continued strength in asset prices is going to be tough. I mean, particularly risky asset prices, because the type of conditions that will lead the Fed to ease even more than is priced in are probably not the type of conditions that you'd want to be holding things like equities in, right?
Sure.
Because it would be the type of conditions where growth was meaningfully decelerating from the expectations.
Yeah. So, I mean, if you look at, USD swaps, for example, for what interest rates look like at this time next year, uh, the Fed neutral rate is somewhere around 3.1%, right? So essentially what would have to happen is more cuts would have to occur for asset markets to really continue on as they have over the last few months, right? So beyond what's already priced in. So that's essentially what you're saying.
Yeah, that's exactly right. And I think that's kind of the asset market conundrum right now is how are we going to get stronger asset prices here? I mean, particularly like equity prices here.
Hmm.
If you look, just as a simple example, if you look over the last 2 months, long-term bonds at matched risk to equities, which is roughly the right way you want to think about it, have outperformed stocks. And so what that means, long-term bonds like 30-year bonds or 10 years levered to equity type risk are up
Hmm.
something like 8 or 9%. Stocks are only up 6.5%. That's pretty interesting because I think a lot of people are looking at the US equity market and they're saying, oh, conditions are great, stocks are rallying. And the answer is no, actually, stocks are falling behind the bond rally that we've seen over the course of the last couple of months. And that typically is not that's in line with the slowing growth.
Sure.
And I think it could be a little confusing from an outsider's perspective, might just be looking at the stock market saying stocks are up, things are good. And the answer is like, no, stocks are up because easing is expected, and they're not
Hmm.
even up as much as what would happen if you just took the easing impact on equity prices directly.
Right. It's, the best discount mechanism in the world, right? If you just look at the equity markets, right? Yeah. So again, to our point here, it's, further rate cuts actually have to occur beyond what's priced in uh, for equity markets and risk assets to continue on. You can even make the argument like you'd have to go beyond rate cuts and see some potentially even more accommodative policy from the U.S. central bank to really see equity markets and risk assets continue on over the next few months here.
Yeah, I mean, I think
So,
probably the biggest lever here, which is probably one of the more challenging levers to fully appreciate, is whether or not tariffs stick around. If you had a situation where
right.
you had
Good point.
the Supreme Court knocked down the tariffs, that would be
Exactly.
very
Yeah.
growth beneficial.
Well, and looks like there's been at least some initial review from some of the high courts in the United States they're basically saying that these tariffs are unconstitutional, right? If you just look at from a checks and balances, historically tariffs um, were implemented through Congress, not through the executive branch, right? So, the question becomes are there additional, to your point, legal levers this administration can pull to actually fully implement tariffs? And again, an unknown, right? That's an unknown, right?
Yeah, I mean,
So,
we could really get nerd out here on tariffs, but the short story is that the administration has several levers to implement tariffs. The one that is under the most legal jeopardy is called IEPA, which is essentially a somewhat blanket law that allows the president to implement policies in response to a stated emergency.
sure.
The core sort of legal question here is whether or not, um, I should say, within that law, that includes the ability to engage in regulation of imports, but it does not give explicit ability to engage in taxation of imports, which, as you mentioned, is traditionally a congressional behavior and responsibility. And so the basic legal debate is, are tariffs a form of regulation or are tariffs distinct from regulation? And what I'd say is there's a lot of uncertainty here. Like the appeals court ruled 7-4 against the administration, but there's four people who said that, who made the argument that it's regulatory, and that those folks they weren't only from one political side or another. So there's a lot of ambiguity here. So hopefully the Supreme Court will hear this soon. I think the challenge is we may be living with this uncertainty until next summer, unless they choose to accelerate the ruling on the docket, which again is unclear.
Sure.
But if they were to break, that would definitely point to a positive outcome for the U.S. economy.
Right. So again, shifting gears to more of the fiscal side, because we'll finally start seeing, we'll finally start to see potentially some of the positive impacts of the one big beautiful bill. Specifically, if you just look at the retroactive implementation of tax cuts and SALT deduction, things like that, that will take place early on next year as we all pay Uncle Sam and everyone files their taxes, right? So um, you know, that in my view is potentially on the peripherals a positive impulse for the consumer, which if you're just looking at the way that the economy is structured now, with call it 50% of the consumption um, uh, earmarked for call it the top 10% or top 20% of income earners in the economy. Are these rate cuts and are these the fiscal stimulus that I just described through the feature of retroactive tax cuts next year? Are these positive stimuli for the economy, or are these kind of more of a blip on the radar? And as we kind of pointed out earlier, does more have to be done from an accommodative policy perspective to further boost the economy, especially for the lower income cohort in the economy?
Yeah, it's definitely the elements of the big beautiful bill that you're highlighting are definitely positive, and in some ways you can kind of think to to simplify the big beautiful bill, because there's a lot of stuff in there.
Sure.
You basically have three pieces, which is one is a variety of different tax cuts,
Mhm.
and SALT deduction and things like that. Two is a reduction in services, particularly for the poor. That's a drag on economic conditions because those are essentially transfer payments to the poor, either directly or indirectly. And then the third is the accelerated expensing of investment, which is certainly directionally positive, although is likely muted given outside of really the AI capex, there really isn't a lot of desire to engage in much investment in the economy. It's actually interesting for all the talk of AI capex. Gross fixed capital formation by businesses is actually down in 2025 relative to the last couple of years. And so everything other than AI is actually down a lot, basically growing at zero, even though AI investment is ticking up. And so you sort of net that mix out, and I'd say it skews a little bit positive. It's a modest positive support to the economy. The question is how, that modest positive support is probably not that big a deal relative to something like tariffs, which are running close to 2% of GDP in terms of an incremental tax hike. And then you've got also the constriction of immigration, which, whether you're leaving aside the political aspects of it, immigrants who come into the US economy work and earn money and
Sure.
spend money, and that is
Right.
positive for economic condition, positive for GDP growth, I should say. And so that too is a drag on GDP growth numbers. And so unless there's a meaningful shift either in immigration or in the tariffs, those probably overwhelm the benefits from the big beautiful bill in terms of an overall growth outcome that we're seeing. So more likely that we see sort of 1 to 1.5% growth in the U.S. economy, maybe 2 at the high side, whereas in 23 and 24 we were more looking at 2 to 3 and even a bit above 3 in certain circumstances.
Yeah, and of course, there's direct knock-on effects for asset allocation and for asset markets, right? We already touched on what actually has to happen from a rate cutting perspective and monetary policy perspective for risk assets to continue on. So that really puts what you're doing at Unlimited squarely in focus as to how investors should think about potentially hedging some equity market volatility that may transpire over the next months and weeks here. And I know you guys have been pretty innovative in what you're delivering to the masses. And again, I'll mention this again in full disclosure. We do have an allocation to HFND in our model portfolio suite, which has done incredibly well. So thank you for the good performance there. But beyond that, what else are you delivering to investors to address some of these issues that we're describing, not only from the perspective of hedging equity market volatility, but thinking about your traditional stock bond mix in context of a 60/40 portfolio and ways to enhance that diversification, specifically through that traditional fixed income portfolio hedge that we've all been accustomed to over the last, call it 10, 20 years, in a macro backdrop of low inflation and okay growth along with lower rates.
Yeah, I think when I think about this environment, it's quite similar to other late cycle environments.
Sure.
And in those sorts of cases, I think one of the challenges is you have to be very agile in terms of managing your portfolio. Meaning, look, if you had gone into all cash at the beginning of this year, you obviously would have trailed both stock and bond investing and 60/40 broadly. Then again, if you had just been long only through this whole period, you would have experienced substantial volatility that always is a challenge for any investor to stomach. When stocks are down 20%, it's always a challenge for investors to stomach. And so in a lot of ways, what we see is our product set, which is hedge fund strategies in the ETF wrapper, is giving investors this sort of ability to add tactical allocations to their portfolio. So what we've seen, for instance, is for global macro managers, they've been able to tactically trade bonds short coming out of Liberation Day, long over the course of the last 8 weeks, shift from being somewhat underweight equity risk to then picking up their equity risk, trading dollar positions and gold, all tactically, which I think highlights the fact that this is both a macro environment, meaning macro policy and dynamics are driving asset markets, but it's also a tactical environment where you don't necessarily want to, put on a strategic asset allocation and then just, go away and know that it's just, stocks are going to go up every day, right? It's much more challenging. And so I think you have basically as an investor, you have two choices. One, you can do it yourself, which is hard. Take it from a
Right.
guy who's been doing it for a few decades. That is hard. It's hard to time the markets. It's hard to navigate it, particularly if you have other things going on. Or another option is basically hire the best minds in the world who are tactically navigating these sort of environments and add those to your portfolio.
Sure.
And that's really what we're trying to do with our hedge fund strategies in the ETF wrapper.
Yeah, in essence, what you're saying is two different things. Number one, what you're doing at Unlimited in context of not only your multi-strategy ETF, your macro ETF, your global long short ETF, and keep me honest, I think there's one more that you also launched, managed futures, which, and again, I'm surprised I forgot that one. That's probably one of the most beneficial to any sorts of these environments, and everything that you just described in terms of being tactically aligned with a portfolio. But in essence, the way that you can think about it from a portfolio construction perspective, if you're running, in a strategic asset allocation 60/40, potentially carving out some of your risk or even some of the fixed income portfolio to add on to the chassis of that strategic asset allocation, and let the great work that you're doing at Unlimited Funds really be indicative of the tactical asset allocation within that portfolio. And then the other part of it too is something that you just described as well, from just an overall diversification perspective, is correlations are always evolving, and it's tough, especially in an environment that we manage assets in today, where things move so quickly within the span of 6 months, to readjust and really be nimble enough to put on a trade to do that. And the product that you're delivering continues to be able to address both of those issues, both from adding just to a strategic asset allocation and being nimble within context of the correlation, modestly higher or positive correlations that are, again, making a lot of asset allocators scratch their heads today, right?
Yeah. Yeah.
Go ahead.
I mean, I think the challenge for most folks who are just basically looking at equity risk and bond risk, meaning just putting those two assets in their portfolio, is that it's pretty constraining. Like if you're basically, if you can only be long bonds and long stocks, that's a pretty constrained environment. And so part of what I personally really like about the hedge fund strategies is not only is there that tactical ability, meaning to go long, short, increase your risk, cut your risk in response to underlying market conditions, but also this idea that you can kind of go anywhere, meaning, the best, when I look at, for instance, macro managers, they've, in the last 5 months, that strategy is up 25%, but it's only had an 0.3 beta to the S&P 500, which highlights the fact that actually some of the most compelling trades in the last 5 months have not been stocks, but have been, for instance, short the dollar, or long gold, or even something as esoteric as long live cattle, which has been a great trade. Those sorts of trades, when you have a go anywhere sort of portfolio, which is what these hedge fund managers are looking across the spectrum to find great risk return opportunities, you can start to build portfolios that have good returns, that can match sort of equity like returns over time, but can be complementary to equity exposure and a bond exposure in the portfolio.
Yeah, and look, and the other point to highlight is everything that you're describing is institutional caliber. At the retail level, it's almost nearly impossible to actually do this, right? You have to be running large pools of money to actually efficiently execute on this. So the best thing is you're able to deliver this in the context of a tradable ETF, right? There's no, you and I touched on this during our first call. There's no hoops you have to jump through from a sub-doc perspective. It's, as easy as placing a trade or, allocating to any model portfolios that we're running or, working directly with you all to add that to your strategic asset allocation. So, again, on the forefront of what the industry continues to demand and delivering really good returns. And with the beta of, 0.3 that you just described to equities, it's a meaningful shift from what bonds would potentially present from the perspective of diversification and negative correlations, right? So only additive. And the way that I kind of also think about what you all are doing and just diversification more broadly is also if you're as I played collegiate soccer. For soccer fans, you can substitute it with American football. But you're not going to field 11 goalkeepers, or you're not going to field 11 quarterbacks. You have to have someone to catch the ball. You have to have someone block for you. And in context of that, like having multiple positions within the portfolio that not only can deliver in a very tactical trading environment, is ultimately beneficial to diversification. It's almost the way that I think about it is like you're going to have positions in your portfolio that you may not like, but you'll really like them when you see the equity market volatility that we were accustomed to that happened earlier this year too, right? Now, from a strategic asset allocation perspective, it does help with drawdowns within the portfolio. So it does help smooth that kind of return profile, which is, in my view, from the way that I think about allocating capital for our model portfolios, very much so in line with what we're trying to deliver from an expected return perspective, right? So that's why I also think it fits nicely within context of what we're trying to achieve for our clients too.
Yeah, I mean that's what you're looking for when you're adding something is diversifying, good return, which is
Exactly.
important because
Yeah.
people you know returns matter for
Of course.
advisors and for
Yeah.
clients. And then on top of it, what you're really looking for is things that can help play defense when certain other aspects of the portfolio aren't doing
Exactly.
well. And I see that's one of the things. The challenge with being long only is what can play defense. And I think a lot
Yeah.
of people are, sensibly a little skeptical about bonds these days. And so I think certainly a strategic allocation to bonds, they might be skeptical about that.
Sure.
One of the nice things about these more tactical strategies is, you can essentially rent the bonds when they're a good bid, and you don't have to hold them strategically uh,
Mhm.
over time. That's a simple example. Like as we talked about before, bonds have actually performed very well in the last 6 or 8 weeks. You may not
Mhm.
want them forever, but you wanted them the last 6 or 8 weeks in your portfolio. And so
Yeah,
finding
100%.
folks who have that flexibility to um, come into markets and then step away from them when they're no longer providing that good return or diversification benefit to something like stocks.
I agree. Let's talk about like sizing, because I know you have done some work on this and I have as well. What is the optimal sizing for let's call it a managed futures or long short, or let's just use managed futures for conversation purposes to for diversification and enhancing your quote unquote Sharpe ratio within the portfolio. You know, I've seen as much as 20%. You know, what is your optimal sizing position?
Well, I think one of the key things is how do you get enough bang for the buck on your portfolio
Hmm.
um, from these strategies? Because the challenge is a lot, if I just talk about sort of like alternative strategies in general, and particularly like long and short liquid
Sure.
alternative strategies, the challenge with a lot of them is that they just don't have that much juice, meaning they don't have
Sure.
that much, return that's going on. And so when you look at them, you're like, I have to allocate a lot to
Mhm.
those strategies to get enough that matters to the portfolio. And so that's actually one of the reasons why when we launched our individual hedge fund strategy ETFs, we do it at a 2x target return.
Mm.
Essentially, think about it like matching equities. The goal over time is to basically meet equity returns or do a bit better than that. And that's beneficial because what you can do is you can add it to your portfolio, but it's cash efficient. So you don't need to put, you know, 20, 30, 40% of your allocation
Sure.
in order to get enough juice to it. You can put in 10% in terms of these strategies and still have, meaningful impact on the return outcome, relative at the overall portfolio level. And so when we talk to advisors, what they're typically doing is they're looking at, 10 to 20%. Some are using our products kind of as a core position in terms of
Mm.
that, and then they might add a few additional managers that they like, that they're familiar with, that they've worked with over time, that also add some alpha strategies to the portfolio, which makes perfect sense. We're in many ways intended to be, we're intended to be what I call alpha indexing, right? So we're
Sure.
trying to, in the same way you might buy SPY or something, or BND or something just straightforward as sort of a
Mhm.
core position, and then might have some satellites. We're really focused on being sort of that core alpha position that's in your portfolio.
Excellent. Yeah. So a couple ways to think about it. We described, um, adding it to the chassis of an existing strategic asset allocation to get that tactical exposure we just described, or using it as a core within the portfolio and building around it. I like it. I like that approach as well, especially in the ever-evolving correlation and diversification environment that we continue to see. Bob, I always appreciate your insights. Thank you so much for your time. Any final thoughts before we end our call here?
No, just thank you for the support. You guys have been a great partner as we've been building our business, and it's been a very exciting time at Unlimited. We've had the assets are growing well, getting a lot of traction with advisors, and but we won't forget those folks who were early supports to what we were doing. So I really appreciate all that you've done for us, from the beginning.
Right back at you. We appreciate the partnership, and we continue to uh, work together and look forward to the future of what happens with markets, right?
Yep, for sure. We'll certainly have plenty to talk about in a few months the next time we get together. That's for sure.
I agree, and I look forward to that conversation. Thanks so much again, Bob. We really appreciate it.
Thanks for having me.